Now, in the meantime, some private equity firms are looking to go public. In the last several weeks, the Blackstone Group filing for an IPO, and people with knowledge of the discussion say that Apollo Group is considering one as well. Joining us now to talk more about it is Mark Palmer, partner at Bracewell and Giuliani right here in New York City. Mark, thanks very much. Listen, we brought you on. We booked you to talk about potentially Apollo and some of these firms going public. But I got to ask you, any comment on the headlines on Kerkorian? I mean, does this come as a surprise to you?
No, it doesn't really come as a huge surprise. Kerkorian was, of course, invested in GM. He's shown interest in the auto sector. He seems to think that he knows some things about the business that could help turn it around. It's got a lot of troubles, a lot of things that they have to face, union issues, retiree issues, market issues, just what is it that they're selling and do people want to buy it? And I think it's a great opportunity for somebody with answers.
Yeah, more headlines here crossing. In fact, Trescinda, Kerkorian's arm, would offer what he calls substantial part of the equity in the company once he bought it to the UAW. Right. It's kind of like what Zell did with Tribune, employee ownership. I mean, it seems like a smart political move internally with the company.
Right. Well, the focus, of course, will be on substantial, and the UAW is obviously
What does that
important.
mean, substantial?
Yeah, absolutely.
All right. Financing here. Kerkorian, listen, he's a rich guy. I don't think he's got $4.5 billion in cash sitting around, although you never know. We've talked about potentially a $100 billion deal in private equity. Is the global liquidity story just going to continue? I mean, there's just so much money out there that the Blackstones of the world, the Kerkorians of the world have no problem finding the cash?
Right. Two pieces to that, Brian. And people keep forecasting the end of the liquidity boom, and it just doesn't seem to be happening. All right. First, a lot of people are putting money into equity. U.S. pension funds, now non-U.S. pension funds. There's a huge flow into private equity funds and into alternative investment vehicles by people who traditionally have not been there. So there's a huge flood of capital into the fund
Because there's
managers.
returns, because they can't get the return in the bond market, 4.5%. Blackstone Group and a buyout there looks a lot more attractive.
It looks terrific, and people are just feeling better about it because there's been a good track record. And then on the debt side, people continue to fund these deals, and they're very highly leveraged. But people are looking for coupons and they're looking for returns, and so the debt markets are holding up. And as long as they hold up, you're going to see big deals.
You know, we had eaten a bit of your time here because of the DCX headlines here. Can I ask you to stick around? We'll go through the commercial break, come back, and talk more with you about this.
Sure.
Because I want to talk about potentially a $100 billion private equity deal.
Right.
Never know, but we'll talk more about it. Mark Palmer, Bracewell and Giuliani, he's going to stick around here. We got to eat those headlines here. Just to reiterate, Trescinda Corporation, which is Kirk Kerkorian, who's a billionaire, it's his private equity firm, offering $4.5 billion to buy Chrysler. DCX stock, it was at $317 just a few minutes ago. We began the interview. It's at $390 right now. So DCX just absolutely soaring here. A number of headlines. We're going to flash them for you on the bottom of the screen. We'll get more on that. Continue our discussion with Mark Palmer here when InFocus returns on Bloomberg. Stick around. All right, Kirk Kerkorian's Trescinda making a $4.5 billion offer for Chrysler this morning. Headlines breaking minutes ago. DCX stock soaring. You can see there it is a big move for DCX. And in fact, that chart is wrong. Guys, pull that chart off because Daimler Chrysler stock is up 383 right now to 84.32. It's not just up a buck something. I don't know why that came up. DCX, anyway, doing well. Trescinda saying that it will offer a substantial part of the equity to the United Auto Workers. Also, it would make investments in product development as well. Kirk Kerkorian, of course, controls Trescinda. Kerkorian is a billionaire who has made investments in the auto business before. In fact, making a huge purchase of GM stock last year, then selling it, then buying it back. So it's a gentleman who is not afraid to get involved in the auto business. We are going to have much more in this breaking and developing story throughout the day here. All right, well, now we are back with Mark Palmer, Bracewell, and Giuliani to talk more about private equity and sort of, I don't know, serendipity here that you're on the air to talk about private equity, and we have a $4.5 billion offer for Chrysler. But let's talk about something else. And I don't want to minimize it because Chrysler is a big company with a long American history, but $4.5 billion in the grand scheme of private equity wouldn't be that big of a deal.
That's mid-market these days, Mark.
Yeah, it really is. I mean, it's almost, barely noting private equity coverage. How long do you think it will be? Because others I've talked to said it's just a matter of time. How long before we see a $100 billion private equity deal?
All right. Impossible, obviously, to forecast exactly. A $100 billion deal will happen. It makes sense that it will happen. Companies of that size, they can't merge with strategic partners. The funds are getting a lot bigger. The debt capital markets are holding up. So these opportunities are available for funds. And right now, the market doesn't think those deals can happen. So, of course, the large caps don't have the private market value expressed in their stocks. Smaller companies do because they can be bought. When people realize that the larger companies can be bought, of course, the stock prices will go up. But the deal has to happen first, and it will happen.
How many financial sponsors would it take It's not the first line of a joke, but how many first financial sponsors would it take to buy a $100 billion company?
Well, you hit on the key issue is going to be complexity, because although there's a lot of mega funds, you still have to club together an awful lot of sponsors to make that deal happen, even if you had, say, 80% financing on the debt side, which some of these deals are getting. I'd forecast it would take probably 10 or 12 sponsors to come together. They'd have to be significant. And so I think what the market should look for is, when do we cross that 50? When do we cross the 50 level? When do we first get to midfield on this thing? And when people can pull a group together and pull a $50 billion deal down, and if the debt markets hold up, and if there's not a lot of government interference in the way that these clubs are coming together, then they'll move to the next level.
Do you think that KKR and the Blackstone Group and maybe some others are thinking about a $100 billion deal? I mean, listen, you got to admit there's got to be a little bit of ego involved here as well.
They're market leaders, and they compete for airtime. They compete for assets. So of course there's competition among them, and I'm assuming they are. They must be thinking about a deal.
In the previous block we talked about how CalPERS and pension funds and non-traditional investors in private equity have all rushed into it because of the returns. Now the returns may be greater than treasuries, but how much less safe are they? I mean, there's got to be some risk here. We haven't seen a whole lot of it yet, but there's got to be some.
Returns are always risk-weighted. If they weren't, they wouldn't last for long. That's for sure. So certainly there's more risk, but that's the point. That's why the funds are allocating 10, 15% of their aggregate capital to these asset classes, because they're seeking the risk and they're seeking the returns.
Do you think there's a feeling out there that maybe the Blackstone Group and KKR and some of the other big players are so smart that there is no risk?
I'm sure people feel as if they have a Midas touch, of course, but they'll tell you there's risk. Everybody knows that there's risks. Nothing ever pans out exactly as you plan.
Mark, we talk about the housing market and sort of the point at which mortgages become expensive, whatever that is, 6.5% for 30 years, 7%, who knows, at which point people will stop buying homes. Is there a similar point in private equity where financing and credit tighten up and get more expensive to where these deals don't make sense?
Absolutely. It's impossible to know exactly what the number is, but when you can achieve 80% leverage on large deals, or 2/3 plus leverage, you can of course pay an awful lot more. And if second lien paper continues to be priced and issued at numbers like 9%, 10%, 11%, you can go a long way. So when that market dries up and when the actual amount of leverage is not available, I think you'll see a cooling off on the deal size.
Or you're going to need a lot more cash.
A lot more cash. That's going to reduce returns, and that means the deal size is going to come down.
When do you think that might happen?
Nobody knows. People keep saying it's going to happen. The debt markets are hugely vital. There's a lot of alternative investment vehicles, the funds that are actually in the debt markets, just like you see the KKRs. On the equity side, there's a heck of a lot of funds out there that are funding the debt market, so there's a lot of money flowing into it right now, and I've seen it unabated so far.
Okay, Apollo Group, considering, according to people familiar with the discussions that we've talked to, considering an IPO, you got a company that basically says to you, okay, say Mark Palmer Corporation, Mark, you don't want to be in the public markets. Be private, go under the radar, do what you want to do. But by the way, we're going to go public. Is there a little bit of irony here?
I think people are looking for irony, but I don't really see it as that ironic, to tell you the truth. I think it makes sense for certain companies to go private. There's a number of reasons why. They may have long-term development product lines. They may be looking to make investments, again, long-term. They may have business plans that need to be actioned, and they need really a lot of management focus, and they don't want to have to deal with the issue of constantly reporting back to the public markets. On the other hand, a private equity fund that's built an amazing franchise, that has built a huge amount of know-how. Blackstone has 400 employees, and they've demonstrated an amazing track record and a name that really goes beyond themselves. There they can get real value from the public markets. They could sort of cash in on the franchise.
Is there another message here, which goes back to our previous point, which might be by going public and seeking to raise capital, they do sense credit tightening?
I think they see a market opportunity. I don't know if they sense credit tightening. Well, that'll just be factored into the pricing of the deals when they go public. I mean, people are going to look at it and try and forecast what's the nature of the return. Are the credit markets going to hold up? Are they going to continue to generate the returns that they've historically generated? And that's going to be factored into the price of the IPO. I wouldn't say them going public somehow means the credit markets are going to fall out. I think it means that they feel like they've developed something important and they want to reinvest in it, and they're looking for some permanent capital to do so.
Conclusion, the end of the year, this is going to be another record year for LBOs.
Absolutely going to be a record year for LBOs. Absolutely.
All right, Mark Palmer, partner of Bracewell and Giuliani. Mark, appreciate it.
Sure.
Thank you very much.